Hi, good morning from Bangkok. We're Minor International. It's our pleasure to be here to present to you our third quarter results and update our performance and recent development. My name is Chayapat Paitun. I'm a Deputy Corporate CFO and Head of Strategic Planning of Minor International. And next to me is Kun Jutatip Adunpan, the Vice President of Investor Relations of Minor International. So let's start with the agenda. I'm going to start with highlights, performance recap, and then Jutatip going to talk about hotels. I'll come back and wrap up with food, lifestyle, and corporate information and 5-year strategy. So let's start with the highlights of what we reported for the third quarter. Our core net profit improved by 39% year on year, but on a like-for-like basis, our profit growing by 67% year on year. For 9 months of 2019, core profit grew by 9% year on year. But on a like-for-like basis, it grew by 17% year on year. I'll explain to you a little bit more detail in subsequent slides. And in this third quarter, we have done a strategic asset rotation strategy, which resulting in our successful deleverage plan. We have sold 3 Tivoli assets and released them back, which we have already explained in the previous quarter as well, but the transaction has been completed and recorded in the third quarter. As a result, interest-bearing debt declined by 10% to about 112 billion baht at the end of third quarter, as we used the proceeds from sales of those Tivoli assets to pay down some debts. Our D ratio declined to about 1.35 times at the end of third quarter 2019, on track with our deleverage plan, which we aim to reduce the DE down to about 1.3 times at the end of the year. So those are the key highlights of the third quarter. But going forward, in the fourth quarter, we're still confident that we would be able to deliver a very strong fourth quarter of this year on the back of the recovery of our hotels portfolio. Be it Thailand, Middle East, and African portfolios start to see some signs of significant improvement, as well as the NH contribution, the momentum of which still continue with the strong profit growth that they report during third quarter and 9 months of the year. We also confident that in the fourth quarter of the year, they will remain to report a very solid quarter, and then the EBITDA and profit guidance still on track so far. And also in the fourth quarter of the year, we're probably going to see some of the residential sales coming through. So there'll be more sales activities from residential development business of ours, as well as the continued recovery of Anantara Vacation Club, which start to see recovery since this third quarter already. We're probably going to see continued recovery in the fourth quarter as well. Also, we announced our investment or acquisition of Bong Chong restaurant chain in Thailand, which will provide some upside growth for Minor Food and Minor International as a whole as well. I'll talk about it in subsequent slide, as well as the Minor Food transformation as a whole. The group transformation is now underway, which will probably going to strengthen our capabilities and result in higher growth and recovery in quarters to come. So let's start with an investment in Bong Chong. Bong Chong is the international restaurant brand well known for their Korean style fried chicken. So we announced this investment in the existing outlets of Bong Chong in Thailand. The investment amount is about 2 billion baht, and then we get a hold of 100% stake in the company, which which is called Chicken Time. Chicken Time operates over 40 outlets of equity-owned Bong Chong stores in Thailand. At the moment, in the slide, we show that Bong Chong today has 44 stores, with another 2 stores to be opened by the end of the year. Just to explain to you what the history of Bong Chong is in Thailand, they first opened its first outlet in 2011, and then they have become more popular among Thai consumers. Overall, globally, Bong Chong has about 300 branches worldwide, with its footprint in 9 countries: Thailand, Philippines, Kuwait, Singapore, Bahrain, Vietnam, US, Cambodia, and Myanmar. And it's now already invested in the 100% of the existing over 40 outlets in Thailand, but we're also now in the process of discussing with the Bong Chong master franchise rights holder to acquire the rights to further expand Bong Chong outlets in Thailand further. That's still underway. If you look at the investment rationales of Bong Chong, we think the opportunity for growth of Bong Chong is quite substantial, given the fast-growing chicken market in Thailand and also the sizable Asian food market. If you look at the growth over the past few years, they've been showing a good growth, strong growth in relative to other food category. So in terms of market size and growth potential, we believe that it's going to be a strong contribution for us in the future. We also look at the opportunity to expand outlets further in the future, and we believe that based on our analysis of other players in the market, as well as comparable benchmarking with other markets, we see some room for Bong Chong's outlets to grow from 44 outlets currently to about 150 to 200 potentially in Thailand in the future. And if you look at profitability and their performance, the payback period of the store opening is less than 1 year, which offer us with some a very handsome return. And if you look at profitability in terms of margins, EBITDA margins of Bong Chong is significantly high and higher than some of the minor foods existing brands. So we would leverage on Minor Foods operating platform, operational excellence to accelerate growth trajectory for Bong Chong, and in terms of physical outlets and also in terms of deliver service too going forward. In terms of transaction, the price that we paid is pretty it's quite comparable with transactions that happen in the market. We show in the slides the M&A transaction that take place in this space, and also trading comparables with the listed food companies in Thailand, as well as food company in Southeast Asia. You can see that the trading comparables of these companies has averaged between 10 to 13 times in the past. So our transactions is hover around this range. Moving on to third quarter performance recap, our core revenue has increased by 86% year on year, and our profit also increased by 39% year on year in the third quarter, primarily from the consolidation of NH Hotel Group. This is core revenue and core profit growth. If you look at our reported revenue and report profit, we report even higher level of growth because there's some non-core or non-recurring items. But if you look at just core, we have a contribution from NH Hotel Group, which helped
differentiate us from other players in the market. So we still see some strong, robust performance despite the softness in other part of our businesses, which were impacted by external factors, including global slowdowns, uncertainties, FX headwinds, and sluggish domestic consumption demand. But we still report good growth on the back of our acquisition strategy. And we also show 9-month core revenue almost double, primarily because of the contribution from NH, and also core NPAT. It increased at a lower rate of 9%, only because the NH first quarter was their low season, so they have some negative contribution in the first quarter, as well as FX headwinds and means organic operation. But anyway, in the third quarter, it's a strong season and strong contribution from NH, and it helped support revenue and profit growth overall. We also show you the like-for-like NPAT growth and revenue NPAT growth in the third quarter and in the first 9 months of the year as well. As you know, we have our financial performance has been adversely impacted by strengthening of the Thai baht. So what we did here, we stripped out the impact of FX headwinds and also the impact of additional lease payment that we have to pay because of the sale and leaseback transaction of our 3 Tivoli assets that happened in the third quarter. So if we strip out the FX impacts and the lease payment from the successful asset rotation strategy, our profit in the third quarter would have increased by 67% instead of 39%. And our profit in the first 9 months of the year would have improved by 17% as opposed to only 9% year on year. This is just to highlight the like-for-like underlying operation growth. And if you, so we're moving on to minor hotels. I'll hand over to Juthad.
Going into minor hotels, if you look at in terms of the financial highlights, we actually saw revenue growth of about 162% for the 9 months. EBITDA doubled, and net profit was up by about 27%. So if you look at the waterfall chart on the right hand side, you can see that primarily it's because of our timely diversification with the M&A of NH. So the contribution of the increases was primarily from the NH consolidation. So that's actually helped mitigate the headwinds that we've seen across our organic operations. We'll go into a little bit more details on the organic performance. So this is minor hotels performance excluding NH. So if you look at the 9 months numbers, the revenue is down by about 4%, and that's across the different business units that we have, with the exception of the management contracts. So if you look at our own hotels, the revenue actually declined by about 5%. So that's primarily because of the soft performance of our Thailand hotels, especially in the provinces, and also the adverse impact of the strengthening of the Thai baht against the currencies that we're exposed to, together with the tragedy in Sri Lanka. And also keep in mind that with the 3 hotels in Portugal, in Lisbon, that we transferred to NH, we also no longer recognize the revenues or EBITDA or net profit in minor hotels numbers anymore. So that has also been moved to NH's performance. For the management letting rights, we saw revenue decline by about 11% in Thai baht term, and that's primarily because of the RevPAR was down about 5% in Aussie dollar term, and the weakening of the Aussie dollar against Thai baht by another 10%, also further contributed to the decline of the revenues of OAKS or management letting rights. Management contracts that I said earlier, because of the is the only part of the business actually saw an improvement in revenue, so it's actually up by about 12% in the first 9 months of the year, and that's primarily because of the good performance of the hotels in the Middle East, the Maldives, and the contribution of the additional hotels that we just opened in the past 12 months. For the mixed-use business, the revenue declined by about 9%, and that's although Anantara Vacation Club actually recorded a turnaround, but we still see timing mismatch of the residential sales, which we didn't see any in the third quarter of this year, versus there were some record of the sales in the third quarter of last year. But we see that fourth quarter is promising. We should see residential sales coming in the fourth quarter of this year. In terms of EBITDA and net profit, we've actually seen a decline by about 16% and 18%. So that's primarily because of the lower flow through of the owned hotels, as we saw negative RevPAR, especially in Thailand. And also the management letting rights business also saw revenue decline, and also real estate operations. And of course, we had the foreign exchange headwinds as the Thai baht was very strong in the third quarter of the year. Now going into NH, NH actually continued to report strong growth. So revenue was up by about 6%, primarily because of the RevPAR growth. Their EBITDA grew by about 13%. So now they have about 209 million euros of EBITDA, which is on track for them to their commitment of getting to the 285 million euros of EBITDA by the end of the year. And net profit was also up by about 57% for the core net profit. So again, they continue to commit to the 100 million euros of net profit for the full year. So that's on track for them. And primarily they still see the margin improvements from the cost savings, cost controls, flow through from higher ADRs, and also lower financial costs for them as they've paid down their convertible bonds and some of their bonds that would be due in 2023. In terms of international exposure, so today for minor hotels, 88% is of the revenue is coming from international, whereas 12% is from Thailand, and that will continue going into the next 5 years for us. Just to recap on the portfolio, in terms of number of rooms, today about 25% of the rooms are owned and 44% are leased, and 19% is managed, and 9% MLR. In terms of revenue contribution, today owned and leased is about almost 90% of our total revenues. So what we're trying to say is for our portfolio going forward, the most important driver for our hotel business will be owned and leased portfolio. And in terms of geography, as you can see today, we are about 60% in Europe, both in terms of revenue and net profit, and that's of course from the acquisition of an H hotel group. By year end, we expect the Europe contribution at the net profit level to come down a little bit, because fourth quarter is Thailand and the Maldives and other destinations high season, so they should contribute a bit more. But again, Europe, Thailand, and the Maldives will be our key geographies going forward. Just quickly on the stats, today in terms of for the owned and leased hotels, again, the most important part of our portfolio, number of rooms have increased by about over 600%, and that's from the consolidation of NH, of course. Organic RevPAR excluding foreign exchange impact, was up by about 2%, and that's primarily from our own overseas portfolio. If you look at system-wide, RevPAR, it's down by 39%, and that's primarily because of the consolidation of NH, which has lower ADR and RevPAR than us, and also because of the foreign exchange headwind as well. Going a little bit into detail, for Thailand, we've actually seen RevPAR decline by about 5%, and that's primarily, as you can see from the graph below, primarily because of the hotels in the provinces. In Bangkok, we saw flat RevPAR, and in terms of occupancy and rates, just like down by 1% and up by 1%. Occupancy is down by 1%, ADR is up by 1% in Bangkok. Whereas in the provinces, we're still seeing pressure on both occupancy and ADR. Going into the fourth quarter, though, which is a high season, we're already starting to see improvement in the trend. So we're seeing slight positive overall RevPAR growth. And again, it's driven by Bangkok. So we're seeing increase in RevPAR for Bangkok. But provinces, we're also seeing an improvement. So it's come to kind of flattish RevPAR in the provinces as well. For overseas, we actually saw RevPAR decline by about 6% in Thai baht term, but again, that's because of the foreign exchange. If you exclude FX impact, then the RevPAR of owned overseas hotel actually increased by 7%. So in local currencies, Portugal continued to perform well. Brazil continued to perform well. They both saw a 3% increase in RevPAR. Maldives saw a 9% increase in US dollar term, and that's primarily from rate increase. Again, pretty much the same story throughout the year. And Africa in local currency, it's also up by about 32%, primarily driven by hotels in Zambia. For NH Hotel Group, as I mentioned earlier, they actually saw RevPAR increase of about 4% in the first 9 months. In the first for the quarter, it's actually a bit slower, about 2%. So Spain was the best performer with RevPAR of about 10%. But Italy and Benelux also performed quite well. I would say the two kind of like destinations that was a little bit slow for them has been Central Europe, because of less trade fair calendar in the third quarter, and also because of Frankfurt facing a little bit of oversupply situation, and also Latin America because of the impact of the hyperinflation in Argentina, and also the currency depreciation in Colombia as well. A little bit of an update on NH integration and synergies. So we've completed, as we've announced earlier, the transfer of the Tivoli portfolio to be on the platform of NH in Europe. And also the other thing that we've done is NH actually has a hotel in Cape Town in South Africa. So we've also taken over the operation of that hotel, because Minor Hotels already has an African hub that the hotel can leverage on. Also in terms of cross expansion, so we've actually leveraged on NH's relationship with the real estate investors and owners, whereas we have the Anantara brand, which is quite strong in the luxury segment. So we mentioned earlier, I think last quarter, that we have actually rebranded one of the hotels in Spain into Anantara since July, and we've also recently announced the signing of a management contract in Dublin in Ireland that will also become an Anantara later, maybe next year. So the integration with NH is still ongoing, and we'll continue to report once we have more progress. Just turning a little bit on the asset light business, which today is less than 10% of overall minor hotels. So on management letting rights, in terms of number of rooms, we actually increased by about 6%. But in terms of the RevPAR, as I mentioned earlier, in Aussie dollar term, RevPAR is down by about 5%. And that's primarily because of the softer demand from the softer economy of Australia, and also the strengthening of the Thai baht against Aussie dollar. So in terms of Thai baht, RevPAR is actually down by about 17%. So if you look at in terms of revenue, it's declined by about 11%. For management contracts, we've pretty much doubled, almost tripled the number of hotel rooms, and that's primarily from the consolidation of NH Hotel Group. RevPAR organically was down by about 1%. And in terms of overall system-wide, it's down by 16%, again, primarily because of the consolidation of the NH portfolio. But in any case, the revenue increased of the management contracts increased by about 11%, primarily because of the new openings. This is the expansion pipeline. I won't go into detail, so we continue to build the pipeline for future expansion. In terms of invested or leased hotels, we have 27 hotels in the pipeline, and for management contracts, we still have about 63 hotels in the pipeline to be opened over the next 3 or 4 years across the brands that we have. Lastly, on the mixed-use business, which today accounts about 5% of minor hotels. In terms of residential development, I think, as I mentioned earlier, we still have the same pipeline, and we haven't sold anything in the third quarter, but we are confident in the fourth quarter pipeline, so we'll probably be able to sell something. And for Nantara Vacation Club, we continue to see growth in terms of number of members. It's still increased by about 18%. The drivers continue to be China, Thailand, Singapore, Hong Kong, and Malaysia. And we've increased the inventory to 238 inventories. So if you look at all in all, the mixed use revenues actually declined by about 10%, although revenue of Anantara Vacation Club increased by 9%, but we didn't sell anything in the third quarter. That's it on the hotel side. I'll hand it over back to Kun Chayapat.
Minor food performance in the first 9 months of the year, revenue grew by 1%, mainly from the outlet expansion. We have impacted by slower same-store sales in the first 9 months, especially from Thailand. So that has dragged EBITDA and profit down by 9% year-on-year and 24% year-on-year, respectively. That was as a result of not only slowdown and contraction in same-store sales growth, particularly in Thailand, but also we took this opportunity to overhaul and beef up our capability within minor food. We strengthened digital capability. We spend and invest to grow our sales and promotions. So that's also put some pressure on profitability to a certain degree in the first 9 months of the year as well. If you look at total system sales, there's a growth of 4.3% in the first 9 months, mainly as a result of outlet expansion of 6% year on year. The brand that expand the outlets quite significantly compared with others are the Pizza Company, Dairy Queen's, Burger King, and the Coffee Club, as well as Riverside in China. However, same-store sales remain negative for the overall portfolio for the overall group at negative 3.8% in the first 9 months. Like I said, it's been dragged by Thailand and Australia, which continue to face very challenging times and market conditions at the moment, even though our China hub report positive same-store sales growth in the first 9 months of the year. So we will continue to beef up our multi-brand portfolio, and also we would also come up with new product innovation and use proactive marketing and promotional campaigns to drive our traffic and drive sales in the upcoming quarters. I'll talk to you a little bit in more detail in subsequent slides. For Minor Food international presence, the contribution from international markets made up about 37% of total Minor Food revenue. So the majority of contribution still coming from domestic Thailand, even though we now have a presence in 26 countries across the region. And over the next 5 years, we expect that our contribution from international will gradually expand to hit 40% of total Minor Food revenue. Let's look at the operating performance or operating stats. Like I said, same-store sales in the third quarter still grew on the back of outlet expansion. Total system sales grew by 3.7%. Outlet expansion is 6%, primarily in Thailand, China, and other development hubs. Although same-store sales still softened by 3.7% in the third quarter because of the weak macro backdrop and slow consumptions overall. However, we start to see an improving trend or improving sign in the fourth quarter to date. October number, November to date number of same-store sales of overall portfolio start to get to flattish level as opposed to negative that we saw in the previous quarter. So that's something that indicative to our stronger fourth quarter performance. So let's look at hub by hub in a little bit more detail. Thailand, like I said, still account for over 60% of total Minor Food revenue. And Thailand in the third quarter saw same-store sales decline by 5% year on year in the third quarter. In terms of brand, Burger King has seen significant recovery though, with same-store sales growth of positive 9% in September. And Bangkok has seen a good month-on-month improvement in same-store sales trend as well. And as I said earlier, we start to see October number and November number improving for Thailand as well, as opposed to 5% drop in same-store sales growth in the third quarter. October and November, we start to see a flattish or slightly positive same-store sales growth for Thailand as well. We still focus on connect with consumers more closely with both physical and digital channels, and we also come up with new product innovations to ensure that the brand's still relevant to the new generation of consumers. And we also beef up our digital capability and also other operational areas of ours, as well as loyalty and e-payment to get more insights of consumer to drive more traffic in the future. We also strengthen our delivery channels with the marketplace moving to using more delivery these days. We beef up our own delivery platform, 1112 and also 1112 delivery, where you can order multiple brands in one single order. And we also work with other delivery aggregators to improve our sales too. In terms of product innovation, I already mentioned to you, I wouldn't go into detail, but each of our brands come up with new product launch and new promotional menus in the past few months, just to create excitement to consumers and draw traffic to our stores. That's Thailand. And moving on to China, China will remain one of our growth driver for minor food going forward as well. Riverside continues to be the main driver of our China hubs. In the first 9 months of the year, net profit of China hub more than double year on year as a result of the effective cost control. And if you look at same-store sales, same-store sales in China softened a little bit in the third quarter by about 2%. But in October, number is start to bounce back to positive territory again. So strategies for China, it's like I said, is to continue to drive Riverside, the Chinese food concept, and we would aim to dominate the grilled fish segments in China, particularly in Beijing and Shanghai, and also we improve customer experience at the store level, as well as promote our food traceability programs to ensure the safety of our food, which is a very important factors when consumers decide to go to a restaurant in China. And also we also invest in CRM and loyalty program as well. So we, like I said, we building our digital loyalty program in China, something that we launched on WeChat, and up to date we have been able to recruit more than 200,000 new members per month. And for food traceability, we try to create awareness of farm to table traceable live fish of our Riverside brand, just to make sure that consumers understand how safe it was and how good the quality of our raw ingredients are on the back of this traceability program. Moving on to Australia hubs, Australia contribute or make up 11% of total minor food revenue. Even though the revenue of Australia increased in their local currency term or AUD term, but revenue in Thai baht declined by 7% as a result of the strengthening of Thai baht against AUD. However, Australia hub was able to maintain profitability in the first 9 months of the year, despite contraction of both same-store sales and total system sales. But if you look at same-store sales, it was in negative territory in the third quarter of 1.9%. But in October, same-store sales rebound to above zero or slightly positive already. So that's contribute to our general view that same-store sales in the fourth quarter to date will become a little bit more better year on year. In terms of domestic operation of Australia, the hubs still focus on product innovation as well as loyalty program. We also work in partnership with Uber Eats to target to improve traffic and delivery sales. So that's all of the hubs of minor food. But going forward in the fourth quarter, apart from the encouraging or improving same-store sales trend that we saw in October and November, we have laid out strategic priority that we have to do for the fourth quarter of this year and also for the next year. We will try to drive same-store sales further, and we also to diversify our expansion, both physical stores and also digital channels, and we also try to beef up our profitability and margins. In terms of driving same-store sales, we'll focus on deliveries, local menus, and increase day part traffic, as well as increase more occasions for people or consumers to come to our stores. In terms of physical store expansion will continue, but not necessarily that we're going to expand only in the form of conventional formats. We will tailor our expansion or the format of the store to be suitable to locations that we expand into. It could be full dine-in format, or it could be delivery or Delco with seats format or smaller formats, which we're going to drive to new places or new location like transportation hubs, new smaller scale communities and marketplace. And also digital, we like I said earlier, we beef up our own delivery platform and work with other third-party delivery aggregators. Apart from that, we believe that investment in Bangchang that I explained to you earlier will also become another growth driver for Minor Food in upcoming quarters as well. So moving on to Minor Lifestyle, I'm going to touch a little bit quickly on Minor Lifestyle. Revenue was up 11% in the first 9 months on the back of fashion and retail trading business. However, EBITDA and PAT declined by 9% and 56% respectively, even though we saw some improvement in sales or same-store sales, total system sales, but the margin has been put under pressure by discounts and promotional campaigns that we have to do for our fashion, and also from the lower operating leverage that happened to our contract manufacturing businesses as well. So that's why profit declined in the first 9 months of the year. Let's look at other corporate information on the balance sheets of ours. Main thing that investor keep an eye on is our leverage ratio. Our leverage ratio has come down. Interest-bearing debt-to-equity ratio declined to 1.35 at the end of third quarter. Now very close and on track to our internal policy target of 1.3, and we still committed to aim to reduce it down to about 1.3 by the end of the year. And if you look at our backup financings, we still have unutilized debt facilities and also warrants that waiting to be exercised. In terms of our balance sheet, I'm just going to summarize a little bit more on that front. We have managed to deleverage and improve the quality of our balance sheet. Now the term out programs of our loans for NH acquisition has been completed. So all the bridging facility has been termed out to long-term loans and bonds. The average maturity of the loan has been extended to over 6 years. Interest all-in rate is below 3% for this NH acquisitions. So, and all the funding has been swapped to euros. Next one is the asset rotation strategy, which has been successfully announced and executed in the third quarter. The sales and leaseback transaction of 3 Tivoli assets have been completed, and proceeds have been used to pay down debts, which also help bring down our DE ratio. And next one is the amendment of the covenant calculation. So the definition of interest-bearing debt in the calculation of debt covenant has been amended to exclude lease liabilities as a result of the upcoming IFRS 16 adoption in 2020, and also perpetual bond treatment. The recent favorable account treatment of our perpetual bonds is still now being validated by the Federation of Accounting Professions. The consideration it's favorable to give the grandfather at least until the end of 2022, but the formal validation is expected to be announced before the end of the year, but now is being validated now. I wouldn't go into detail in 5-year strategy and 5-year aspiration. It's because it's pretty much unchanged from last quarter. Now we're just going to look very quickly on some of the questions that sent over. We have very, very limited time at the moment. The first question is, how many branches of Bangchang you like to open in 2020? Where will be your focus area? Is it in Bangkok and or somewhere else? Well, like I said earlier, we now have invested in the existing over 40 outlets of Bongchong. We're still in the process of discussing and discussion with the master franchise rights holder Bongchong to be able to expand the number of outlets more. Once that negotiation or discussions is finalized, we're probably going to let you know more about our growth plan beyond this existing 44 outlets of Bongchong that we have today. Next questions about the customer of our hotels. They ask if our main international tourist is China. Are they only in Bangkok? How about the tourists in other provinces? I understand that this questions go towards Thai hotels.
Well, if you look at our overall portfolio, about 14% of the customers are from China. So they are the biggest single country in terms of customers, but I would say that we're still quite diversified in terms of the customer base. China is about, as I said, 14% of the overall portfolio. For Thailand, it's about 19%. So, of course, more of the Chinese come to our hotels in Thailand, and a little bit more in Bangkok versus the provinces. Having said that, in NH, they have less than 5% of customers coming from China. So that's also an opportunity for us to grow our China customer base in Europe as well.
Next question on food. Is there any plan to expand to other regions for food, i.e. Korea, Japan, or other regions? Well, the answer is we remain opportunistic. We open to any expansion opportunity, especially anywhere that we already had our presence or our footprint. That way we can leverage on the cluster of the existing platform that we already have for operational efficiency and cost efficiency. So the answer is well, we open to any opportunity, be it acquisition opportunity or partnership under JV or under franchise agreement. We open to all business models if it meets our investment criteria or return criteria. Next question is on our dividend policy. Dividend payout still hover around 30 to 35% of our earnings. That still remain our dividend policy. No change on our payout policy at the moment. I think that's it for the questions today. With the tight limited time that we have, if you have more questions, please feel free to send it over to our investor relations department, and we're happy to address your questions or any clarification we could make. Thank you.